Hey there, everyone. Dave Keller here with Market Misbehavior. Today we're going to look at the chart of Tesla. Is Tesla a trade or an investment? So the month of January certainly has started pretty strong for growth stocks. Some of those leading Magnificent Seven names like Amazon, Meta, Alphabet, others ripping to the upside. And even the Apples with some disappointing earnings results still holding up quite well. But there's one stock that's definitely an outlier, and that's Tesla. While these other names are pushing to new all-time highs or very close to do so, threatening at the top of the range, Tesla is languishing well below its all-time highs and really continues to be in a steady decline of lower highs and lower lows. Now, the issue with Tesla, I guess the good news for Tesla is it's reaching sort of that lower boundary of a trend channel it's been in for the last 6 months or so, and the RSI is actually oversold. So does this suggest that Tesla is more of a trade, betting on a bounce higher, or an investment, more of a longer-term appreciation? We'll look at this stock from a technical perspective, share some of the indicators that are lining up right now, suggesting maybe a bit of a bounce here, and how you might want to manage risk on a stock like Tesla. Before we get to that chart, here's one more thing I want to tell you about. The new year is a really good time to focus on routines. What do you do every day, every week, every month to improve your situational awareness as an investor, to identify potential opportunities and also manage risk? Seeking Alpha provides a quantitative model, what they call their quant rating, and I think it's really well done. A lot of the institutional investors that I've worked with always had an alpha model, which is basically a quantitative model. It's a way of looking at the statistical measures that define healthy companies, strong companies, companies most likely to outperform going forward. Then you take all of those factors, you combine them into a model, and then you regularly run it to find companies demonstrating those same characteristics. By scanning for stocks showing strength using the quant model on Seeking Alpha, I think you have a good opportunity to identify potential opportunities that could help your portfolio going forward. If you go to marketmisbehavior.com/Seeking Alpha, you can get a great deal on their premium membership, which gives you access to their quantitative model, also all of their scanning tools, and also a lot of premium commentary as well. So go to marketmisbehavior.com/Seeking Alpha. Start off the new year with a gift to yourself, the gift of better market awareness and a better sense of the opportunities of leading companies. And now let's get back to the charts. All right, so here we're looking at the chart of Tesla. As you can see, a major low here at the end of 2022, at the end of December, and then the first 6 months of 2023 were actually quite strong. The stock went from around $110 up to almost $300 a share. You can see that, of course, handily outperformed the S&P 500 during that first 6 months of the year. But the second half of last year, not as strong, and what a stark contrast to a lot of those other Magnificent Seven names, just really pounding higher, really accelerating into new all-time highs going into January, while Tesla's actually breaking down in the first month of 2024, pushing more to the downside. Recently, we've seen Tesla gap lower, and I think that's the most compelling signal to highlight just in terms of the price action, because we've gapped below $200 a share, which is a pretty big, sort of key big round number, and also that's right below the October low. So we've gapped below previous price support, and so the question is, do we fill that gap? Do we push much higher? Now, here's the thing. I would argue that some of the indications on this chart suggest that that might actually be the case. A couple things to add on here for you. So if we look at the Fibonacci retracements, what we can do is take the low, let's say from December. We'll take the low from January, actually. Take it to the high there in July. We can see 38.2% of the way down is around 223. 61.8% is right around 177. So if we draw a horizontal line, you can see that's just below current levels, right? Just below 180. So the fact that we've come down from 300 all the way down to 180 actually means we've almost perfectly reset or retraced this stock down about 61.8%. That's a Fibonacci retracement, which is a commonly used technique to identify once a stock has had a pretty big rally and you are sort of filling in that range between those extreme low and extreme high prices. Where might you anticipate some potential support? So not unexpected that we went down to the 38.2% level. We undercut it by a day or two, but then bounced back higher. You can see we eventually gapped below that level, finally broke down here in January, but then now reaching that 61.8% level. So we're kind of at that downside objective using a traditional method called Fibonacci retracements. The RSI is also oversold, and that on its own is not necessarily a bullish thing, because oversold means it's gone down a lot. But what it also means is you're often ready for sort of a counter trend move to the upside. You can see that back here in August when we bounced off of the swing low. You can see that in late October of last year when we bounced off of, we'll call it 190 or so. And then you can see it again here. Now, it's worth noting, the signal isn't when we enter the oversold region. That just means we're going down a lot. So look back here to like mid-December of last year. This isn't the chart telling you that it's a good buying opportunity. What you look for is when we come out of that oversold region, because that means that significant bearish momentum is starting to be alleviated. You're actually seeing some short-term optimism, right? Or some signs that that downward move is exhausted. So that's what I may want to be waiting for here on Tesla. We haven't seen enough of a rebound yet to sort of get out of that oversold region. But if and when we do, then you sort of thinking of more like a January 2023 kind of pattern where we've gone down quite a bit, but now we've sort of alleviated that significant downside momentum. What I also want to show you is a trend line using those recent swing highs. So if you take the high from July, you'll see that lines up really well with the highs from September and October and then November. So I was taught once is chance, twice is a coincidence, 3 times is a pattern. So if you can line up a trend line with 2 points and then that lines up independently with a 3rd point and then even a 4th point, it sort of gives further and further validation to the importance of that level. Now, if you look, we did have a breakout above that level in mid-December, and this is arguably when Tesla was looking about as bullish as it's looked in the last year, right? You saw a break above trendline resistance. We're above both the moving average. They didn't quite slope higher, but certainly felt like we were starting to show some gains above 260, 265, but we very quickly rebounded back below that level. So you call that a failed breakout, where a breakout is triggered. We've broken above trendline support. We've even broken to a new swing high, but there's not enough follow-through. There's not enough additional buyers coming in, pushing Tesla higher. So that failed breakout is actually a pretty bearish sign, because instead of buyers coming in and pushing the stock back to retest the July high, we failed. The buying power dissipated. We have sellers coming in and pushing the price back lower. So what we can also think about then is this trend line is going down. We can also make a parallel trend line. So what we can do on stock charts is actually take that first trend line here and then make a parallel channel and put it down here. So now I've created a simple trend channel, taking those highs that I mentioned earlier. And you can see that, again, just dragging a parallel line lines up beautifully with the August low and the late October low. That coincides pretty closely to what you're seeing here with the Fibonacci 61.8% level. It's a little lower. It's right around 170, 172 right now, but all sort of in this general range. So what this chart is telling you is based on the trend channel, based on the Fibonacci relationships on the structure of the last 13 months or so, sort of that 170 to 180 range, sort of a general downside objective given the sell-off that we've seen and given the overall trend characteristics. So let's say we do get a bounce given the oversold conditions, if that's alleviated, given the fact that we're at this confluence support. Is this a trade or an investment? I would argue you want to think of this more as a trade versus an investment. And here's what I mean. A trade is more of a tactical move, right? Something is, has had an extreme move in one direction. You're betting on a mean reversion, meaning the average trend is certain thing, and then we kind of overcut or undercut. So in a downtrend, we kind of overshoot and undershoot that general trend. Think of a midpoint to this trend channel. And then you're basically betting on the trend being a little too strong or a little too weak given the overall larger trend structure. So the fact that we're at the lower end of this channel, the way you could think of it is maybe we're betting on a bounce back to the upper end of the channel. I don't know if it's necessarily going to go back to 300 anytime soon, but the fact that it's to the lower end of the channel where it's found support before may suggest we have a counter trend move to the upside. In terms of an upside objective, that's how we can use this trend channel to think about where a move might go to. And what's interesting here is the 38.2% retracement levels at 224. The upper end of that trend line is currently around 230. The 50-day and 200-day moving averages are right on top of each other, right around that same point, around 230. So 225 to 230 combines all 4 of those different separate measures. They all come to a confluence of resistance. So what we have here is a unique situation where Tesla is potentially bouncing off of a confluence support. Upside objective potentially would be a confluence of resistance, and that usually means pretty high probability that we can focus on those as good levels of risk and reward. Now, what would suggest that the chart of Tesla is just continuing to break and that this short-term trade is not a great idea? very simply, we break below that trend channel, right? We don't get that bounce. We break below 170 and continue to push lower. In that case, all bets are off. It suggests further downside retracement. That's where you want to look potentially for a retest of the January 2023 lows. That's all the way down to $100 a share. What would suggest that this is not just a trade but an investment? In terms of my toolkit, I would have to wait for a break above the upper end of the channel, right? What the market does, which you have to remember, is price action is telling a story. It's telling you about a narrative of this Tesla price action in a particular trend. And what you're looking for is a deviation from that trend. That's why this breakout in December started to look like something different, what we call a change of character. It didn't materialize, right? Additional buyers did not come in. So what you'd look for is a break above that confluence of resistance and additional buyers come in, which keep us outside of that channel, which keep us above here. And it's a bullish chart above that trend channel. Until we can do that and sustain gains above that trend line, it's just a trade, not an investment, according to the charts. What do you think of Tesla? Do you think it's a bullish or bearish chart here, and why? Don't forget to drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.